And we're live. Hey, everybody. Welcome to another episode of This Week in Real Estate, hosted by yours truly, Ray, a bearded man of real estate. We're broadcasting everywhere. Let's see, what is today? Wednesday, June 31st, 2024. And the show title today is, Are You Not Entertained? And if you've seen the thumbnail, you know why. So today is a Fed day, and the Fed is going to give us a thumbs up or down or neutral. And so we're taking bets in the comments. If you're joining us anywhere online, be sure to drop in the comments. What do you think is going to happen in just under an hour from now? Is the Fed going to drop rates, leave rates the same, or is the Fed going to raise rates? That's one I haven't heard yet, just FYI. Most likely leave rates the same or drop, but I want to know your opinion. Where's it going to go? And we are broadcasting live everywhere. YouTube, Facebook, Instagram, on Ray Zorback, my personal account, as well as the T-Wire Pod. We are broadcasting on LinkedIn. And I think the only place we're not today is Twitter. I wasn't really getting anything from Twitter, so we're taking a break from that one. But everywhere else we are. And if you're joining us live, you could comment, and I could display your comment, and I could talk about you. Or I could talk about your comment, Olivier. He said, before Matt, the golfer. He was first today. Andy Rose checking in with us on YouTube. And if you're joining us on Clubhouse, you can actually come up to the stage and add your voice to the podcast. So this is an interactive show where I go over the latest real estate news and headlines. So please share it with somebody else in the industry who you think may need to know what is going on in this world. We usually focus pretty much on real estate. Every now and then we'll have another article. But you guys just raise your hand. If you have a bio in Clubhouse, we'll add you to the conversation there. So thanks everybody for joining. I'm getting a little buzz. What's the buzz? Oh, there's a buzz in the mic. That means a cord somewhere is a little loose. So I don't know where it is. We'll try to find it. I'll try to find the buzz sometime during the show. Anyway, thanks everybody for being here. Mia, you're everywhere. She's on Clubhouse. She's on Instagram. Oh, look at that. I just fixed it. Apparently the wire was too close to something else, like magnetic or something. So there we are. All right. Well, thanks everybody for joining us. Scap, what's up, man? Scap reminded me that we haven't done a listener roundtable in a while. So I do want to plan that. If you're a listener to the show and you're a regular who drops by and comments and that kind of thing, and you want to appear on camera, let me know. We'll organize that, and you can be one of the panelists. I guess we can, panelist sounds official. We'll do a panelist. All right, so let's dive in. And Hillary, I didn't have time. I didn't. So Rebecca, I think it was Rebecca, a couple of weeks ago suggested, and she listens to she's a audio listener, so she listens to the podcast later. She suggested a T sound effect for the real estate T section, the industry T. And I've started looking, and the only issue with finding these sound effects, you have to find them that are not licensed or that you can use, or you have to buy them. And for some reason, people are real proud of their T sound effects. And it's not like the ending sound. It's like the whole thing. It's like the whole, so I found one, and now I have to cut it and edit it and make it appropriate for the industry T section. So we will have, next week, we should have the industry T sound effect. And we'll dive right in. Oh, wait, actually, there's a whole lot of comments on YouTube. What's up, guys? Elizabeth Nightingale, she's there. She says she bets that they stay down or stay the same on the rates. Matt said definitely down 0.5. I feel like that's a lot. A half a point. Elizabeth's from Charleston. Let's see. Hillary, she loves my thumbnail. Thank you, Hillary. I really worked hard on today's thumbnail. I use AI to assist me with the thumbnail. And for the podcast listeners, it is Jerome Powell, the Fed chairman, as it's not Caesar. Who's the guy in Gladiator? Commodus? Is that? I think that's the guy in Gladiator. And he's dressed with the whole toga and the armor, and he has his fist out straight, and his thumb is not going up or down. It's just his fist. Every time I asked AI to help me to create this, and add the thumb, it would always make it a thumb up. And then I would say, no, put the thumb down, and it would not put it, it would like put it down and the thumb would be really weird looking. And so I kept saying like, put it neutral or sideways or something. And so finally I would just say, make it just punch towards the screen. And that looks like he's about to stick his thumb out. So that's one that's, but man, it took forever for me to get the right one. And then I had to do some editing after, but thank you. Andy said, either way, they're playing politics with the rate. Andy Rose said, stay. Cindy, I don't know if I've ever pronounced your last name. Uriona? Is that right?
That is correct. Good job, Ray.
Look at that. 0.25 basis point drop is what she says. Andy Rose says Twitter is for college sports. That is when I use it most often. If you look at my Twitter history, it's either politics or sports, to be honest. That's the one place where I can do all that stuff. Mike V said no cut, but dovish talk. Dovish talk. What do you mean dovish talk? But like bullish?
Dovish talk.
Whoa.
Like doves, like a dove versus a hawk.
Oh, dove versus hawk. I got you. Yes. Okay. I got it. You're breaking up really bad on Clubhouse there. Then he said it like 3 times. Matt, you must be in a place with a bad reception because your YouTube comment even came in 3 times. All right, so let's dive into the industry tea. First up, we got some more real estate lawsuit news. The NAR settlement, more than 10 million home sellers targeted in a class action media blitz. Ha! What fun. More than 10 million home sellers have been or will be inundated with notices that they may be entitled to receive payment from the proposed commission settlements by a handful of real estate brokerages. JND Legal Administration is the company that's tapped by the lawyers to oversee the administrative talks around the commission lawsuit, known as Gibson, has set more than 10 million postcard notices to potential class members, as well as more than 27 million email notifications since March, according to an additional legal document. Can you, I guess if it's a class action notice and you're on the do not call list, they still call you or they still get to you? That's interesting. If you sold a home or paid commission, this is what it says. If you sold a home or paid commission to a real estate agent, then you may be part of a class action settlement. Already more than 700,000 of the postcards have been returned undeliverable. Yeah, because they probably made bank when they resold their house. Home sellers have until May 9th, 2025 to submit a claim. There's a website you could go to for that. Alternatively, they have until October 3rd to ask not to be included in the settlement or to object to them. And that's key. You don't have to, just because the settlement is there, you don't have to accept it. So you can reject the settlement and then go to court yourself if you wanted to, or do nothing. And then it has details of who can make this claim. I thought the most interesting part of this for me was this direct mail campaign. 10 million people, 700,000 of them have been returned, but 10 million postcards is huge. So expect your clients to ask you about this and what it's about. So if they didn't know about it, they're definitely going to know about it now. It is interesting that the way they may find out about it is through, one of those commercials. Have you been injured? Those type of, it's just going to be interesting to see. Hey, Matt LaMarche, he said, here too, like and subscribe. He's over on LinkedIn, YouTube, and Instagram. So I appreciate the triple view, Matt, and he's on Clubhouse.
I was going to say, it's a lot easier when you're not playing around the golf with Scap.
So that was epic last week. If you missed last week's show, Matt and Scap were on the course, and I used AI to generate course descriptions. How many of those, by the way, were accurate at all?
Well, first off, we are going to get round 2 in soon because I have to even this up. We're doing swings, so be prepared. But actually, a couple. I'll be honest with you. Some of the descriptions were really accurate. I mean, one of them was a par 5, but they said it was a par 4. But I mean, other than that, I mean, I think it kind of nailed pretty much most of them in a really elegant, amazing fashion.
Yeah, I thought it was really interesting, actually. I did not expect it to be so accurate in how, like, it allowed me to read it like Jim Nance or somebody like that would read it and to sound similar. I thought I was going to have to do way more editing to the live read of those. But yeah, that was fun.
Yeah, the only edit, I went back and, of course, watched the entire episode just to see where we can improve as well. Well, mostly Scap, actually. And so if you really just start it by saying, hello, friends, I feel like then you're good for like the rest of the rest.
I think I still have,
No.
I still have some of that music on it. Let me see.
So good. Well, I do feel like, too, there's a lot of people on YouTube, and they're probably just here to get the score, because if they're not part of the contributor chat, they wouldn't
That is
know.
true. They wouldn't know yet. Yeah. Who won? Who won?
So your boy, the realtor, by one stroke.
Nice.
Wheels came off those last couple of holes. I was up by like 6 or 7, I think.
Yeah, you were
I
up
can't remember.
huge until you started to fatigue.
Made a little run at the end there and got myself well within striking distance. But of course, a couple errant drives on the last couple holes kind of did me. But we're gonna get round 2 in at another course, and then we'll see if we can tie it up here.
Hello, friends.
Hello, friend.
Hello, friends. No, that's so I played I really had to do some work on the back end for copyright claims last week, so that was fun because we had some additional music and stuff, and I'm a member of something in which I get to use all this music, and I pay a monthly fee to use it all on all the platforms, and it never fails. I still get noticed like, hey, this video has been demonetized because of your licensed music. So I'm taking issue with them about it now, but it was fine. It was fine. It was good. Ironically, the one that I thought I would get a claim on, this one. Hello, friends. This is the one that I thought would get me, and they did not make a claim. So
That's shocking.
Yeah.
That's shocking.
That's the actual Augusta National sound, and they did not make a claim. So I appreciate if you're watching, Augusta. I thank you so much. Well, that's good.
Well,
Well,
next week we're gonna have like I think break 70 with Donald Trump on there. So
man,
it'll be really good. We'll get a whole.
I know we talked about it last week, but that break 50 that was such a good YouTube. If you're a golfer, you would love to watch it, no matter where your political leanings are. But I encourage everyone to watch that, no matter where your political leanings were, because that was just cool to see.
I started the round off by telling Scap that, and he's like, I don't get political. And I was like, the only thing that he says is, do you think Joe Biden could do that?
Yeah,
and they had a good laugh about it. But that was it.
Other than that, there was nothing political
politics,
on there. Yeah.
policies, nothing. So
that's what I thought was most interesting. Is you
it.
got kind of like a behind the scenes curtain at who the guy is.
Exactly. But yeah, 82 to 83 was the final score. It was pretty ugly there for Scott for a little while, but I just sent him a referral, so hopefully that kind of eases.
Yeah, it eases pain a little bit. You know, it's always easier to cry when I can cry into money.
It's true. So true.
Speaking of crying and money, Elizabeth Nightingale says, wait, I thought the entire settlement was an actual settlement and realtors would not be sued. So there are some caveats to this. Yes, realtors will not be sued, but that is if your clients accept the settlement as well, or don't respond by the October 3rd deadline or whatever that was when we covered in the story. And also, if you're covered by the lawsuit, there's some companies that have to have their own settlement because they sold more than $2 billion, I believe it was. So check with your brokerage to make sure they got taken care of by the settlement. Let's see. All right, let's go to the next article. This one, this kind of created a firestorm last week. And I don't know really who caused it or where it originally came from. I think it was Ricky Caruth. And we talked about it. I think we talked about it last week, but I was so distracted by the good golf round. But now it's out there on all the, Inman, Broke Agent Media and all that kind of stuff is covering it. I was texted by contributors and people that listen to the show. I got hey, EXP is not paying buyer agents anymore. And several people sent it to me. Some people sent me copies of what their broker at EXP had sent them, essentially saying the same thing. And I really didn't think it was worth much of a story because as I looked at what the brokers were saying, it seemed like they would still be able to allow their clients who wanted to pay buyer agent compensation, but they were simply saying that as a brokerage, they would not pay buyer agent compensation. And that's what a lot of the lawsuit was about. So it made sense that a brokerage would do that, in my opinion. So apparently the biggest part of this news story is not necessarily what they said, but the effect of what they said. It seems like the announcement that they made to say, hey, we're not going to pay buyer broker compensation was botched and could have been handled way differently. Now, someone said that Leo, I don't know how to say his last name. Let me find it. Leo Parea. He said, somebody told me that he posted just a blatant post, EXP will no longer pay buyer broker compensation. Somebody else said it was Ricky Caruth that posted EXP will not pay buyer broker compensation. And then they just kind of let that out there to see what happens. I think it could have been said way differently and possibly way better. But now they're in this situation where all these agents were creating memes and all kinds of stuff about EXP and how, I'm not going to do a deal with EXP. And there were all kinds of stuff being said. And Leo had a retort and said those are going to be some very expensive jokes. So if you did say that kind of stuff or memeing about it, you might want to take those down. The truth is, EXP simply is saying what a lot of the lawsuits and settlements have said, that a broker cannot pay, a listing broker should not pay a buyer agent, but the seller can. That's all they're saying. Now, I think the way it was announced made people think that they were saying that they would not offer any compensation on any of their listings. In other words, they would fill in for the seller zero. The listing brokerage published its new listing agreement internally on Friday and provided a document to Inman on Wednesday. It said, we are not going to do broker-to-broker compensation. This was Holly Mayberry. We want to make sure our agents get the best, are best protected. We're not going to do predetermined compensation. There's a menu of options that they'll provide their agents with. The document itself reflects that approach, stating on the first page that the broker EXP does not share commissions with the buyer's broker. That's okay. I think if you're at a big national firm, you're probably going to have a similar agreement. Andy Rose said, "Old Ricky really poured it on, clickbaity. This is the DOJ's dream, pipe dream." Andy, I think Ricky has gone towards the clickbait approach on a lot of it, and it's been okay. But on this one, he actually removed the post, which is an interesting change. These changes reflect the new rules in the National Association Realtors announced this spring, which are set to go officially in effect in August. Despite EXP's updated listing agreement seeming to reflect the new ENAR rules, it prompted something of a firestorm last week. On Tuesday, for example, a post on the popular Lab Code Agents Facebook group racked up more than 300 comments. Topic garnered enough attention that EXP Realty CEO Leo stepped away from his vacation on Wednesday morning to discuss it with the Broke Agent Media podcast. And it was good. He's basically saying what I'm just saying. It's they just botched the announcement. But one of the interesting parts is that I feel like another agency can learn from this mistake, make the same announcement, but make it differently, saying the same thing. So they could come out and say, in part due to, the settlements and recommendations by the DOJ, we will work with our sellers to, I'm just workshopping this off the top of my brain. We will work with our sellers to provide buyer agent compensation when possible, but no agent compensation will be paid by the brokerage itself. So that kind of takes that two-pronged approach where you're saying like, this is how we would do it if our seller wants to do it, but you could be sure that that's not coming from us. So legally you're covered. But also, as a PR battle, you kind of win that battle now. So, Christine Halverson said pro client and pro agent. Yeah. It seemed like the approach that, and somebody told me that the way it was released by EXP apparently had to be released that way because their legal team. I don't really believe that. I think they shared something internally. It got out. Someone else read it, and then it exploded. I think that's what happened, and they couldn't get in front of it. So poor Leo has to come back from vacation to try to get in front of it. Jeb says, sounds like a good reason to consider another broker. Only if your consideration is that they botched the PR of this. If you're thinking that because they're not handling it correctly, I would not agree. I think they're actually handling it correctly. I think what they're doing is right. I think the way they did it needs some work. So it's definitely, Elizabeth said, Ray for president. He makes stuff make sense. Can you imagine? Like that's the campaign slogan. Matt Lamar said, another realtor using clickbait? No. Well, part of the reason why we do this show is to have one place to get the honest. We want honest talk. We don't want sensational stuff. And yes, I will definitely sometimes use sensational stuff in the headlines to get people to click because I'm battling all these people that legitimately will have an entire 30 minutes to an hour of sensational discussion with one little nugget of truth. There was one little caveat they'll put in there and say, but if it's like this, then it's not a big deal. But look at all this. Look at what's happening. And it's just ridiculous. It's a waste of time. And that's not something that I ever wanted to do or be a part of. So our goal is honesty and accuracy, and that's what we're going to stick to. So if you want to go sensational and all emotions, go somewhere else. I will try to be, emotional though, like lively. Oh man, did you really do this? Real Estate Times. What is this? realestatenews.com. While we are on the show, put this article behind the paywall. So I will just, that's stupid. All right. So here's the headline and the article. CRMLS removes key concession details. So the compensation details were removed in May. The concessions in the price field, which include the option to specify a percentage or dollar amount the seller may be willing to offer a buyer. This week, however, CRMLS Board of Directors voted to remove the two field options. As of July 30th, the concessions field title Seller Willing to Consider Concessions will only have a yes or no option for the listing agent. We felt prudent to try to avoid confusion between all parties is the reason why they... So I can still read it. It's down here below the little paywall. That's ridiculous. So that's the California CRMLS, California. What does it stand for? California Realtors Multiple Listing Service, California Region. But the California Association of Realtors. No, that's not it. What is it, Mike? What does the CRMLS stand for? Oh, where'd he go? He's not here. All right, well, fine. The California MLS. That's what we'll call it. So they had a concessions field, and I had warned about the concessions field on previous shows because a lot of agents were saying, well, I'll just put the percentage in the concessions field. And I think we said on the show that may not work. Now, since then, NAR has released additional guidance, which shows that maybe that does work and the way to do it. But I would say it's still a bit of a risk to put a seller concessions figure there and just make it all negotiable. I think that's the best way to do it.
Regional.
Oh, California Regional? Is that what it is?
Correct.
Okay. That's interesting. All right. Well, let me see if I can get this article to, I think that's the bulk of the article, but I just want to make sure. Oh, yep, it is. All right. Well, next up, we have another one from the same realestatenews.com, and it is not behind a paywall. So why? This one says REcolorado gets a positive response from the would-be owner of REcolorado gets a positive response. So you might remember that REcolorado was being purchased by Jay Burks. I think it was Jay Burks. And that name came out, Joseph E. Burks. That's what it is, president of Equity Title in Colorado. As soon as the bid was made, there was all kinds of hubbub about this deal. Similar to the EXP debacle recently, it was mainly a PR misstep. So instead of announcing it to members, here's what's happening, here's why, here's who it is, here's their promise to us. We're excited about the transition as we sell REcolorado to this other purchaser. Instead of that, it was kind of done in secret, and even the board was removed once they found out, because then they leaked the information and breached a non-disclosure. So then they all had to be removed. So DMAR and the South Metro Division Realtor Association, SMDRA, those members met to discuss the sale of the private equity headed up by Joseph E. Burks, president of Equity Title in Colorado, and approved the changes to support the transaction. We are more happy with how the meeting ended today, a representative for DMAR and SMDRA told Real Estate News. While a few members expressed concern, the majority of members in attendance appreciated the opportunity to engage and provided positive feedback, including thanks, hugs, and support. And this comes on the heels of a software company making a bid last week. MRI Software submitted an indication of interest in pursuing REcolorado. The details were not revealed in that. But I thought that was interesting. They got another suitor, they got another buyer, they got another bid. But everybody, once they had a chance to meet with the Joseph E. Burks equity title guy, they liked him, because he said from the start that they would be supporting agents and continuing the long-standing tradition of service, blah, blah, blah. And it just goes to show you that people are afraid of what they don't know. And they're afraid of, things that don't make sense to them, things that they don't know the reason why. Why is it this way? And that led to all kinds of heartache in both of these situations, EXP and REcolorado. So let that be a lesson for any brokerage out there that's going to make any announcement. Carefully, please walk it through your PR department. That's why they're there. California Regional Multiple Listing Service. Thanks, Jim. I just saw that. And Elizabeth, I just saw this comment too. She says, I foresee all brokers eventually staying away from cooperating brokerage payments. Mm-hmm. There are some MLSs, and I'm wondering if REcolorado is set to do this now that they're being sold. There are some brokerages, MLSs that are saying, hey, we are not part of the suit and we don't agree with the suit. And we think not offering buyer agent compensation or not making that public what the offer is allows space for fraud and space for fair housing violations. So, which I tend to agree with. What is legal and what is ethical currently are now different, in my opinion. What is legal, brokers should not pay another broker. What is ethical? Well, now you allow a seller to determine the race, creed, color, religion of their buyer simply by saying, for this person, we will accept their offer. Even though we make a little bit less, we're going to cover their agent fee. For this one, we're not going to cover the agent fee because I don't like the way they look and they wouldn't fit in our neighborhood. And so you're making it very difficult for somebody that's maybe disenfranchised to purchase a home in an area that they want to live. By having a brokerage pay that fee, you're essentially saying, here's someone that's bound by an ethics agreement and an agreement to work together with other brokerages in their area. And if there's discrimination, then they can be held liable. by having the seller do it, I think you're going to hurt a lot of people. So there's no fair housing rule. A seller can sell to whoever they want, and there is nothing anyone can do about it. So, what's up, Kevin? Kevin Amoroso says, I'm glad you're saying it. Mia says they are discriminating again. Yeah, I agree. Mia said that we're going back 60 years. Yeah, and it'll take a couple of laws. I think that is all on the industry T section. Yeah, we had the EXP thing, and let me click out of these. Oh, yeah. That is all. So that's all the industry T section. Let's get into the economy. Again, the Fed is going to make an announcement in about 30 minutes. We'll have those details, and we'll cover that live. Oh, that's interesting. Andy says, in free speech. Yeah, I don't know. I mean, speeches, I don't know. I don't know if it does mess with free speech or not. I'm kind of torn on that reasoning. I like the reasoning. I think it's MLS Penn or NWMLS that's saying that. That is saying that, you know, by saying you can't say this, it messes with free speech. It's a good try. I'm anxious to see if they win with it. I don't think that's going to be a reason to win, because there's all kinds of things that laws say you can't say or you can't do in a transaction that is different than regular speech. But it's worth a shot. Let's see what happens. All right, so let's go to the next article here. Is on Fox. This is Glenn Kelman. Is it Kelman? Why am I blanking on his name? Yeah, Kelman. Glenn Kelman, the Redfin CEO, says housing market is in a funk as homebuyers weigh election uncertainty. So Byron Lazine took issue with this on their show over on Broke Agent Media, and I thought it was really funny how he took issue with it. He was like basically saying, no way, you know, it's not election uncertainty, it's the economy. And there's a quote. Who said this quote? It's the economy, stupid. That's the quote. That's, I think, accurate. I think a shift in purchasing always happens during an election year. You always see a slowdown, but you don't normally see a slowdown of this magnitude. And we'll talk about that as we get into some of the actual data from the economy. But Glenn says housing is in a funk. Even though the interest rates have dropped 20 to 30 basis points over the last few weeks, we've seen home buyers still on the sidelines. That is 100% true. Despite the recent economic hardship homebuyers have faced, Kelman predicted that the U.S. critical presidential election is the real issue, why buyers have been shelved. The real issue might be the election. We've talked to so many homebuyers who say they're going to wait and see what happens this election. It is gripping the national psyche. So we have some people that are waiting, but it's because they think other people are waiting. It's like, well, I guess buyers are waiting now, so we're going to wait. Like, well, they're actually not. We're working with several buyers. We're showing buyers this week. So there are buyers that are looking, but I think it's interesting that maybe the perception is causing the reality. Inventory is going to remain low for a long time just because people who got a 3% rate aren't going to give up the loan, as you suggested. So we know the state of play, but even within that context, I think affordability is the real problem. Bam. That's the real issue. So again, we're the no spend zone. Can I have that phrase? Buyer definitely took this guy to task. But he does say that the real issue is affordability, and that's what it boils down to. How bad is affordability, you ask? Oh, I'm glad you asked. $1 million starter homes may be the new normal. That's not a great feeling. California leads the charge of cities with $1 million starter homes. That's wild. California has 117 cities. That's up from 53 in 2019. New York has 31 cities with starter homes up to $1 million. That's up 13 from 2019. Jersey's 21 cities. That's only up 2. Florida has 11 cities. That's up 4 cities from 2019. Massachusetts, 11 cities with $1 million starting homes. That's the same. Who has the biggest increase? I guess the other large one is Washington. There's 8 cities up from 5 in 2019. Oh, wait, the biggest increase, that would be Massachusetts, 11 cities. That's up from 0 in 2019. Oh, wait, hang on. I'm stupid. I thought I thought it was up 53 or up 13, but it's up from 53. So California is number one because it's 117. That's up from 53 originally. I was misreading the graphic. My bad. The real Peter Rader said, I lost 850 list to a 1.3 offer. What? Kevin Omarosa says, people are certainly holding back, but we continue to take loan applications every week, not really slowing here on my side. That's what I would say too. All right, so let me reread this chart. My bad. California has 117 cities. That's up from 53 in 2019. My brain was not computing what I was saying there because I thought surely that's not correct. That is wild. So there are 210 cities total where the typical home is at least $1 million. $1 million gets like a luxury home here. $1 million in Arkansas, and you're like a king. You can buy whatever you want. So if you are in some of these cities and you're like, oh man, I don't want to pay $1 million, just come to Arkansas. You can buy whatever you want. Factors driving the $1 million starting home trend are the housing shortage, which we've talked about ad nauseum. While typical U.S. home has increased 49.1% since 2019, starter home values have increased by 54%. So starter home values have increased at a higher rate of speed of others. Wow. Peter said his offer, he put 1.1 on an $850,000 list price and lost to a 1.3. So is there hope for first-time home buyers? Let's see. For one thing, typical starter home nationwide is 196,611. So it's really just in those main cities, those 210 cities, because the typical starter home nationwide is 196,000. That is a crazy difference. One of the reasons, though, why people are sitting on the sidelines is there are other things that affect affordability, too, one being insurance. Homeowners insurance premium rose 21% last year. Why? Climate change is partly to blame, experts say. And I feel like I am in, I just can't believe that no one has made this connection or said anything about it. But a year ago, maybe 2 years ago, we talked about how now they could use future casting, climate change data to come up with prices for your insurance. So no longer were they going to look back and say, this is a 500-year floodplain. It hasn't flooded in 500 years, so we're going to classify this as a 500-year floodplain. No, they can look forward and say, well, based on climate change data, it looks like this place is going to flood in 20 years. And because of that, we need to increase all the premiums in this area. We talked about this on the show, and it's like everyone forgot. And so now they're saying that the climate change is what's causing the increase, but it's not necessarily that the client have natural disasters risen 21%. No. So why is your homeowner's insurance going up 21%? It's because they're using different data. They're able to now, because I guess the government said they could, futurecast and say, this is what we think is going to happen in your area, so we are raising the price. And no one mentions that. No one mentions that change. Consumers are preparing to renew their homeowners insurance policy may experience some unexpected sticker shock. Between May 2022 and May 2023, homeowners insurance prices rose an average of 21% at renewal time. A rise in catastrophic severe weather contributed to this jump. Experts say the rate of price increases is not expected to slow as insurers face higher costs. So what percentage? What's the percentage of the rise in catastrophic weather? Minimal data available is from insurers. It's convenient. For many insurance companies in the Gulf Coast area that economically survived Katrina, the next year was one of their most profitable years because their premiums adjusted for Katrina, but there wasn't a Katrina event. So the challenge of insuring, so that's the challenge of insuring climate change. Yeah, and future casting. Patsy Metcalf over on Instagram says the current government doesn't want Americans to enjoy homeownership. It's definitely more difficult than it was. Understanding how premiums will continue to rise in response to severe weather is hard to gauge, according to Martin. The data is pretty minimal. Insurers don't share how much they're charging individual homeowners with the world. And there's not a lot of reporting. Well, we know they're also pulling out of states that have had, and I know that anytime I'm asking a certain company, I'm not going to besmirch them on the show, but there's a couple of companies that we've run into several instances where we are getting quotes and they are making it nearly impossible for us to use them as an insurer for a good property, a fine property. But because the roof is a little bit old, 10, 15 years, they're not wanting to insure the property and they're raising their premiums to astronomical prices. Elizabeth said, how about a tiny house and one fry? What? Oh, I missed some of what you were talking about there. I see. Andy Rose said he couldn't afford the fries. Oh, wait, reverse it and flip it. Are you trying to make an allusion to the song, Matt? Andy Rose said, and when it doesn't flood in 20 years, do you get a refund? That's a great point.
Yeah, with interest. So does someone said tiny homes, and then I thought someone said Christina Smallhorn, but didn't flip that.
I think you have to say it 3 times in a row, and then she appears.
Tiny home, tiny home.
Yeah. Maybe she'll drop by. All right, so this is another report, kind of the same deal. A housing study from Harvard says housing costs have hit highs. Rising cost of housing is making it hard for many Americans to make ends meet, and monthly rents are rising faster than wages, according to a new housing report from Harvard University. The Joint Centers for Housing Studies of Harvard University report was released in June. Annual report says the deals are hard to come by. Let's see. Middle and lower income renters are seeing a shortage. We've lost 6 million low rent units over the past 10 years. I thought that was interesting. We've lost 6 million low rent units. And then they have anecdotal stuff where they're interviewing people that are searching for homes and such. So yeah, rising cost of housing. This one's focusing more on the rent side. So housing's up everywhere. Rent has slowed though. The rent increases have definitely slowed, and multifamily rent increases have also slowed. What's up, Joe? Joe says golf. Joe Gearlash. Did I say your last name right? I don't think I've ever said it out loud. I'm saying more last names out loud. Golf was last week, Joe. Kevin Amorosa said, we're definitely getting more renters to get qualified here in Florida. Okay. And Phil Farmer Realtor says, where did they go? That's a great question. Where did the 6 million units go? We've lost 6 million units. Where did they go? I think some of this is, some of the properties are being redeveloped. We saw a uptick in the redevelopment. Some of the properties now have owners sitting in them because when home prices were soaring, investors exited the market. So they took their gains off the table and sold their home to people living in them. So now you have a shortage of rentals because you have more people that bought them. And the shortage of rentals will have rent prices go up to a certain point, but they've definitely slowed currently. Mia Zoll says rent is increasing so much. I don't think it's increasing as much as it was last year and the year before, though. At least not in our market, and not from what I'm hearing from investors who are investing all over the U.S. They're experiencing a slowdown everywhere. Let's see. So if the GDP wants to see 1 million homes, you still did not spell that right, Phil. Phil tried to correct his spelling and put HO.ES. That's hose, sir. All right. All right. So he said, so GDP wants to see 1 million homes a year and we lost 6 million. Yeah. Well, let's talk about the luxury market too. I thought this report was interesting from Redfin. It says that luxury home prices spiked 9% to an all-time high. So luxury prices rise more than twice as fast as non-luxury. Wow, look at that chart. So for the audio listeners, this chart looks a little bit like, an EKG, except the bottom spike of the heart is not going down as far, and it's just one beat. That beat happens from the year 2020 to the year 2023. And then it kind of goes back down towards the flat line and then comes up recently. So luxury is 8.8 and non-luxury is up 3.8. So we are still seeing price increases, which that's one of the things that, your buyers will say, well, I want to wait till prices come down. It's not, just show them this chart, and they will look at this chart and they'll see prices will go down, but prices aren't going down in this chart. This is the percent gain. So all but 2 years have home prices on this chart, or maybe 3 years, have home prices not gained. And there's only one 10-year period in history where home prices have not gone up. And that's because of the crash of 07, 08. So just show them this chart and they'll think, well, yeah, home prices are going down. You say, no, this is the gain. So if a home goes up 0%, it's level. There's only 2 recent spikes on this chart where home prices declined, and both of those spikes are luxury. There's only one slight dip in non-luxury. So home prices are still going up, and it's mainly because we don't have the supply. Mia said it looks like a heart attack. Yeah, I bet if your heart was doing this, it would not be good. It's not a good, that's not my area of expertise. I'm just trying to explain to the audio listeners what they're looking at here. Phil, to his response of misspelling the word home, says currency is currency. Mia says, what will their home be worth in 2 years? Not that much. They should sell now. That is a good point. So you could say, well, the rate of increase is going to slow. So if you bought a home and you're up 24, 25, 26%, something crazy because what happened in the last couple of years, in the next couple of years, it will probably only go up 4 to 6%. That's normal home appreciation. And so you could take your gains now and go buy something. That's not bad. That's not bad advice. Let me see if there's another chart. Yeah, here's the luxury sales. They're flat. They're as flat as non-luxury sales. Non-luxury sales fell a bit. It's down negative 3.4%. Luxury is only down 0.2%, or maybe it's a positive. Yeah, it's a positive 2.2%. So non-luxury sales down a little bit. Luxury sales flatline. Crystal Zrinch, a Redfin Premier agent in Fort Worth, says there's still strong demand for well-priced high-end properties, especially those that were presented beautifully and move-in ready. Yeah. And we don't have a crystal ball to what interest will be. That's a good point, Mia. I think this is a key phrase from Crystal here. This is something I marked as I was reading this article earlier. There's strong demand for well-priced, high-end properties. Well, yeah, well-priced. Oh, where'd it go? Well-priced, high-end properties. If the price is not compelling, the home is not selling. Steve Harney, the late Steve Harney now, actually, of KCM, said on stage at Tom Ferry event several years ago, and I've always remembered that. In a tough market, if a home is not priced well, if it's not a compelling price to pull up the buyer, specifically in luxury, then the home will not sell. And for years, he talked about the domino effect, how someone would graduate college, they would get married, they'd buy their first home. It was a little rinky-dink starter home. Then a couple of years later, they would sell that home, go to a slightly bigger home, then sell that home, go to a slightly bigger home. And there was this domino effect as people were moving around until they got to their big home, which was the luxury home. Now, It's opposite. Now people seem to be pulled into the housing market or pulled up from the market where they currently are. So if you have a luxury listing, if it's not a compelling price point, then someone's going to stay where they are in their, in our market, luxuries probably starts around 600, 700,000. So if I have a non-luxury home, in the 400,000, but it's got a 2 to 3% interest rate on it, and it's enough space, it's not exactly what they're looking for, then they have no need to move until they see the one. And when they see the one, if it's not priced right, they're not going to move. But if I can compel them with a really great price, then they're going to want to move to that next property because they feel like it's a good deal. And I think we're back at that point. There were a couple of years where we took a break from that, it seemed, but now we're back in that situation where if the price is not compelling, the home is not selling. All right, let me see if there's any other worthy charts on here. Luxury homes are rising faster than non-luxury. New listings for luxury homes jump 11%. Non-luxury homes are only up 2.6% on inventory. And that was about it. You guys can see more of that report from Redfin. All right, we were on the heels of the potential interest rate cut. So drop in the chat. Are we going to see a cut? Is it going to stay the same? Or do you think the Fed will raise rates? Here's a hint to those that may not listen often. No one thinks that the Fed is going to raise rates. So Elizabeth Nightingale said same. Several of you have been commenting over in the, what's up, Armando? I don't really get to the chat over on Clubhouse very often, but thanks for joining the show over there. Let's see. He asks, how does the timing of an election year influence consumer confidence as purchasing behavior in the real estate market? What correction could be observed between the election outcomes and subsequent home buying trends? It always slows a little bit. I don't know about necessarily the trend around values, but it does slow a little bit. It just doesn't slow as much as it has lately. So it seems to be more of an affordability issue. TLIRWIS. Irwis? TL or Ty Irwis? Is that an I or an L? Says it's not the interest, it's the insurance and taxes. Hillary thinks interest rates will stay the same. Courtney McCullough says, I think the same. All right, we're on the heels of that. Here's an article I want to show you. The first Fed interest rate cut in years is on the horizon. So there is usually, Elizabeth said, I like being surprised. I said same, but I hope it's cut. Surprise me. Usually there is something leaked to the media and we kind of know what's going to happen before it happens and the market already prices it in. This has not been as widely circulated or leaked, I don't feel like. There's not a lot of people talking about an interest rate cut. There's some, but not a lot. So they don't seem to have leaked much to the media this time. This article says that there's a potential cut on the horizon, but it is asking when. When is that cut going to be? The Federal Reserve is poised to make the first interest rate cut in years this fall, which can influence mortgage rates down. Even small cuts in rates could make a meaningful difference in what a home buyer will pay. To that point, people in the market to buy a home have been eagerly waiting for the central bank to cut rates. Rate cuts are already priced into the market. The first rate cut is almost entirely priced into the financial markets already, especially bond markets, said Shin Zhao, economic research lead at Redfin. In other words, they call Redfin an online real estate brokerage firm. That's interesting. Huh. In other words, mortgage rates aren't going to change much once the Fed actually begins to cut back. A lot of these rates are already priced in. A lot of these rate cuts are already priced in. So people are claiming that the rate cuts that are going to happen in the fall are already priced in. And so it may not really make a difference if you wait. My question is, when will the cut actually happen? Oh, look, we just got the announcement. Boom. Let me go to this live. Oh, wait. Hey, wait. I have a breaking news sounder. Here it is. Breaking news from This Week in Real Estate. That's right. The Federal Reserve concluded its two-day policy meeting Wednesday. This is breaking news. Check back for updates. That's all the article says. But we know from the title that the unchanged as expected. The Fed leaves rates unchanged. So all of you who said the same are absolutely 100% correct. What I think is most interesting about this is that there was some discussion on when is the rate cut coming? Are they going to wait? Are they going to cut now to avoid the political ramifications of saying, well, the Fed is obviously playing politics with the rate cut because they cut it right before the election? Several people in the contributor chat said the rate cut is going to happen in September to avoid the look or the perception of politics because it's not that close to the election. However, it does give them time for that to take effect. So Andy Rose said, yay, what do I win? Exactly, no rate cuts, it's smoke and mirrors. Maybe it will be a double secret probationary rate cut. Animal House, that's funny. They held rates. Where's your breaking news? I just did. Sorry, I'm just now getting to your announcement, Olivier. But yeah, I think it's going to be hard for them to deny a rate cut at the next meeting, but they're also not going to want to seem like they're playing politics with rates. But everyone is going to think they're playing politics with rates who aren't really tuned in to exactly what's happening. So we'll get the oh, look, wow, that's so fast. They're so fast at writing these articles. It really makes me think they just have AI do it. Washington Federal Reserve officials on Wednesday held the short-term interest rate steady, but indicated that inflation is getting closer to the target, which could open the door for future rate cuts. Central bankers made no obvious indications, though a reduction is imminent, choosing to maintain language that indicates ongoing concerns about economic conditions. Albeit with progress, they also preserved a declaration of more progress is needed before the reductions can happen. Quote, the committee judges that risks to achieving its employment and inflation goals continue to move in better balance. Inflation has eased over the last year, but remains somewhat elevated. In recent months, there has been some future progress towards the committee's 2% inflation objective. Yeah, I was kind of half hoping for a cut, but I feel like it's too early. Word salad said, is it Thai or is that an L? Is it TLIRWIS? Spell it out for me. That way I can give you the appropriate shout out. Let's see, a few other tweaks. They voted unanimously to keep its benchmark overnight borrowing rate target between 5.25% and 5.5%. That's the highest in 23 years. There's an article on Broke Agent Media that talks about what the Fed should really be looking at. Optimal inflation policy should largely ignore housing, says the Minneapolis Fed. Mark Zandi said, take a look at the important recent paper by researchers from the Minneapolis Federal Reserve. The researchers conclude the optimal monetary policy should largely ignore shelter prices and target price stability in non-housing sectors. I 100% agree with this take. Yeah, sorry, I was reading some of your comments over there on the Insta. Highlights from the Minneapolis Fed report is that the recent surge in housing costs and specifically rents has contributed to inflation remaining above the target in many countries, including U.S. Advanced economies across the globe saw rapid rise in inflation post-COVID, and the central banks have responded by tightening the monetary policy. Nearly 2 years later, inflation remains above the Federal Reserve's 2% target, primarily due to housing inflation. So they're basically saying cut rates because the problem is housing. But here's, I would love for this to happen. But the problem with this is if you cut rates, then we know that more buyers will be pushed into the market. And if more buyers are going to be pushed into the market and there's not a solve for the current inventory issue, then what's going to happen? Well, home prices are going to soar again. They're going to go way up. So that's going to create a situation where, you don't have incomes going up where you want to. Employment might be okay, but it's not really want to. And so it's going to affect Fed policy. that tries to keep everyone employed and tries to keep prices on goods down. The way to keep prices on goods down is by restricting orders. The way to restrict orders is by restricting money. So if they said, well, let's take housing out of it completely and look at everything else, then they're no longer restricting orders. They're going to be putting more money out into the economy. So the prices of everything are going to continue to go up. So while I would love for this to happen, to get a rate cut so that people can have a lower rate whenever they purchase a home, I also am nervous that a rate cut right now would send everything through the roof. The prices of everything would go crazy again. So I'm iffy. All right, I got a couple of, I've only got 3 more articles here. I'm going to cover those real quickly. A typical home buyer's monthly payment drops to the lowest level in 4 months. So there's some good news on the horizon here. So the housing payment was $2,671. It dropped to $166. That's good. Many would-be buyers are still waiting on the sidelines, largely because even though mortgage rates are coming down a bit, home prices are just shy of record high. And that won't reverse. That's the problem with this policy of ignoring homes. Home prices are up. That's why it's hard for people to buy a home. It's one of the reasons why it's hard for people to buy a home. So I can't imagine what would happen if we just ignored housing, lowered the rate, more buyers shoot into the market. Inventory. We got to solve inventory. Another article says housing affordability is moving in the right direction. That's probably in part due to inflation, right? The median new mortgage payment. Oh, this is kind of the same data. Homebuyer affordability conditions continue to improve for the second straight month as declining mortgage rates continue to increase purchasing power and enticing some borrowers back into the housing market. That's Mortgage Bankers Association Vice President of Housing, Edward Sealer. Housing affordability is improving ever so modestly. It's moving in the right direction. So here's the average rate on 30-year fixed. Look at that Cinnamon Toast Crunch ad. That looks so good. They nailed me with that one. All right, we have the last article also kindly went behind a paywall. Let me see if I can use a different browser. Yes, that worked. All right, we'll share this tab instead. Bam. Investor regret is up as purchases hit the lowest point in 2 years. Investor activity is noticeably down. Investors accounted for 23% of single-family home purchases in June, which represents a 5% drop from January. Some investors are regretting their purchases. Shifting investor sentiment could be contributing to the decline in activity. Why would an investor be regretting a purchase? Maybe because they bought at the height of the market and now rents have tapered a little bit. Half complained of issues with bad tenants and or property damage. More than half of the respondents indicated they had to evict a tenant. 60% said they had to track down missed payments. Cash purchases are also falling. So the number of investors buying with cash is low. And if you're getting a loan, you're getting a loan at 8, 9, 10%, I guess, right now. So investors are regretting their purchase. This might be a good time, if you have a buyer right now that can't find what they're looking for, to check the county records for people that own multiple properties and see if you can, if it's in a neighborhood that your client wants to buy, see if you can make them an offer. Because if they're one of these investors that are regretting their purchase, they may love to entertain that offer for you. All right, so that's all I've got for today's show. Oh, wait, that's sorry. Whoa, I know I got some of you excited with that one. You're like, oh, another breaking news. What are we doing? No, I was on the wrong board there. So there you go. All right, well, thanks everybody for joining the show. I really appreciate all the feedback. Thanks for popping up on Clubhouse and adding your voice to the conversation and for commenting. Please be sure to do all the subscribey things and share the show. But I appreciate you guys being here this week. If you have an idea for an article, if you saw something that we didn't cover, send me a DM. You can find me at Razorback. That's RAYZORBACK over on Instagram. Shoot me a DM there. And if you want to be in the contributor chat, let me know and I'll add you to our WhatsApp group where we just talk about articles and what's happening in the economy, what's going on this week, that week. So, and there's sometimes some silly stuff in there. So, all right, guys, thanks. I'll see y'all next week.